Hi everyone, my name is Rodney Appiah and I'm the Chairman and Co-founder of Cornerstone Partners. As you approach completing a funding round, one of the most important things that you need to consider is how to build a sound financial plan. And there are a few tips and words of advice that I want to give you as you think about doing that. The first thing to advise you on is to think about it from a cash perspective rather than from a P&L perspective. What I mean by that is really consider the cash flows in and out of your business and the investments that you need to make over the next 6 to 12 months in order to scale your business appropriately. Do you need to invest in products and services? Do you need to invest in staff? Do you need to invest in third-party suppliers? All of these considerations need to be factored in a detailed monthly cash flow plan, and that will give you a really good handle on what's required from your investors. The second consideration for building a sound financial plan are the assumptions that underpin it. Are the assumptions reasonable? Are the assumptions credible? Do the assumptions speak to what you've done in the past and your capability in order to execute it? Let me give you an example. Let's say you were proposing to raise capital for an e-commerce business. What are the KPIs, the core assumptions that underpin how your business is going to scale over the next 6, 12, and 24 months? How many units, in other words, volume assumptions have you made in your business plan? What pricing assumptions have you made in your business plan? Are prices going to stay static? Are they going to increase with inflation? Are you going to flex pricing depending on the range of products and services that you offer on your platform? Investors do go into this level of detail, and so it's really important that you have a full grasp of the numbers that underpin that plan. The third consideration to building a sound financial plan is factoring in a contingency. In other words, factoring in a proportion of capital that's available to you in the event that things don't quite go to plan. Startups are like life. Things never happen as you expect them to. Startups will have good times and they'll have bad times, and startups very, very rarely track exactly according to their plans. And so a contingency bucket is really important in ensuring that you're not left in a situation where you're going back out to the market having run out of cash. In my personal view, I would factor in a contingency of at least 20 to 30% of capital. So for example, if you're seeking to raise £500,000 based on your cash flow projections, consider a contingency of at least 100 to 150,000. That gives you a very good buffer to ensure that if you don't quite hit your numbers, i.e. you trade at circa 90 to 80% of your top line revenues, you still have sufficient cash to work the way through. One of the most challenging things for founders to do is to estimate the capital requirement for their business. And in truth, there is no science to this. It does require an element of judgment and skill. But here are a few tips and suggestions that might help you on your way. The first tip is to be extremely granular. Be very specific about your cash flow needs on a day-to-day, week-to-week, and month-to-month basis. How do you do that? Well, look at what you've done in the past. Review your accounting statements. Review your receipts. Review your relationships with your third-party suppliers and the terms on which they are expected to get paid, and replicate that into your cash flow statements. Don't apply generic assumptions around when the cash is expected to leave your business, because that is going to create a hole in your assumptions. So be very, very specific. In terms of the second consideration, avoid catch-all buckets and try and break down your cash requirements on an item-by-item, line-by-line basis. Avoid catch-all buckets such as sundry expenses or IT costs. What does IT costs really mean in practice? It typically means hiring outsourced developers. It typically means working with third-party suppliers. It typically means invoicing and hosting provider. Break those costs out so that you have a really good understanding of the cash flow requirements of your company. And then thirdly, don't forget of all the tax and regulatory requirements that those costs might attract, particularly with respect to staff. Often when people assume and project staff costs, they just forecast salaries. That's not really accurate. you've got to factor in national insurance, you've got to factor in employer insurance, and you've got to factor in benefits and even in some cases pension requirements. Often for a salary of circa £20,000, let's say, for a typical employee, there's an additional 12.5% on top of that in respect of NI and benefits that one needs to factor in, that the company will have to incur in order to hire that individual. Also reflect the costs of recruiting that individual in the first place. Often recruitment costs will be due. Onboarding costs in terms of providing them with equipment and services and appropriate training. Don't leave these ancillary costs out of your budget. If you do, you're going to create a hole. One of the most important things that founders need to consider, particularly the early stages of their company's development, is the pricing strategy. And it's often the case that startup founders get pricing wrong, often underselling themselves versus the value perception or the value benefit that they create to their customers. Pricing is such an important enabler of growth to your company, so it's important that you get it right. And I want to give you a few tips and suggestions in terms of how to think about it. But before I do that, I want to give you some data and some evidence. A recent study conducted by Harvard Business School suggested that a price increase has a 3 to 4 times impact on your profitability versus a proportionate increase in volume. Now think about that. It has a 3 to 4x multiplier effect on your profitability. And yet there tends to be an aggressive focus on volume at the expense of pricing. And so it's really important that we try and change that. And I want to try and help you to do that. The first thing to think about with regards to pricing is that there are elements of pricing. In the main, there are 3 core elements to pricing: macro pricing, micro pricing, and specific or deal-by-deal pricing. And I want to walk you through each of those elements in turn. Let's take micro pricing. Micro pricing is taking into consideration the broader market dynamics that you operate within. In other words, what is the supply and demand dynamics for your product or service? What are the market drivers? What's the market appetite for your service? And what are the pricing trends? For example, let's take food, something really simple and straightforward for us to understand. We all know that we're currently living in an inflationary environment where food prices are going through the roof, particularly food prices that are sustainable, food prices that speak to specific audiences, like, for example, vegan, and food prices that suggest a certain level of quality. That pricing consideration in the broader context of the market is important in terms of determining what your price should be and how your offering fits within that broader market. The second consideration is micro pricing. And micro pricing is really about value perception. In other words, what benefit are you bringing to your customer or user? If that benefit is very, very high, that gives you more flexibility to increase your pricing. If that benefit is low, then your pricing needs to be much more keen. That price elasticity of demand is critical. Make sure you get that right. So let's be specific about this. What are your competitors charging? And are your competitors comparable to you in terms of the value that they're providing to your customer? If you provide more value or you provide more of a premium offering, consider raising your prices relative to the competitor benchmarking set. If you provide less value or your strategy is to pursue a value strategy at the expense of premium strategy, then consider lowering your prices relative to the competitor benchmark set. And then the final consideration from a pricing perspective is specific pricing or deal-by-deal pricing. As an early stage startup, it's very important that you're not rigid to your pricing strategy, because one customer, one client, particularly a strategic one, could mean the difference between your business scaling incredibly quickly, gaining really powerful references, and not. And so you've got to take those considerations into account. Have discipline around your pricing structure, but give yourself some flexibility to ensure that you can acquire the appropriate customers at the right time to scale your company. Taking into consideration some parameters and benchmarks that allows your sales staff to flex on your core pricing structure. For example, introducing discounts or benefits in order to convert a customer. Another consideration is to capture the right type of customer. For example, let's say that you were selling both project-based revenue So you were acquiring both project-based revenue and acquiring subscription-based revenue. Subscription-based revenue, which is recurring in nature and is often contracted, is far more valuable than project-based revenue, which is one-off and can quickly disappear. And so incentivize your sales teams to attract that recurring subscription-based revenue and give them the tools and the ability to do so at the expense of project-based revenue, which is less valuable to your business in the short to medium term. So we talked a lot about pricing strategy, we talked a lot about financial planning, we talked a lot about assessing the capital requirement for your business. But now we need to move on to outcomes, and specifically, how do you measure success from a financial perspective? Now, again, this depends on the type of investor that you're speaking to, but in my experience, success is driven by two things. One, your core KPI metrics, and two, the milestones that need to be achieved in order to reach the next funding round. So let's tackle both of those two in turn. The first one, your core KPIs or financial metrics. Most businesses need to have a North Star. What I mean by a North Star is a target or a goal. And that's both financial, product, commercial, team. It can transcend across your entire business. Your financial goal, that North Star that I'm talking about, is something that can help you to determine the success of your business. You might have a goal, for example, to ensure that the cash that you raise gives you 18 months of runway. That can be a financial goal. That can be a financial success metric. You might have a goal to grow your revenue by 10 to 20% month on month. That again could be a financial goal or success metric that you track and that you seek to hold yourself accountable to. So that piece around understanding the key financial and KPIs that determine your growth and determine your success is important. And ultimately, it's about holding yourself accountable to those metrics. Similarly, with respect to KPIs, most businesses operate in sectors that have a standardized group or category of KPIs that business needs to adhere to. Take, for example, a software business. Core KPIs that are related and associated with software businesses include the percentage of recurring revenue, churn. Churn relates to the number of customers that you lose in a given period, and gross margin. Those are three core KPIs that are often tracked by investors seeking to invest in software businesses. How does your business track those core KPI metrics? That can be a measure of financial and KPI success. And let's move on to the next point, which is milestones and trying to achieve that next funding round. Let me give you a bit of a stat. On average, early stage businesses take between 4 to 5 funding rounds to achieve an exit event, i.e. an event where the business is sold, money is taken off the table, or the business lists. So think about that for a moment. 4 to 5 funding rounds are what is required to get that exit event. Because of that, as an early stage investor, particularly at seed stage, I need to have a great deal of confidence that you're capable of continuing to raise further rounds of money. And often those rounds of capital are associated to achieving certain milestones. And those milestones are a measure of success because those milestones tend to be tied to financial and KPI metrics. And so how do you measure success from a financial perspective? Can your business achieve those milestones based on the capital that you're intending to raise? If that is not the case, raise more capital, because otherwise you'll be caught in a loop where you won't be able to move on to the next funding stage because you haven't been able to achieve those milestones.